Picture this, October 24th, 1929, Wall Street. Grown men are weeping openly on the trading floor. Others are frozen, staring at the ticker tape in disbelief as their fortunes evaporate in real time. Outside, crowds gather in stunned silence, watching America's financial elite crumble before their eyes. Within hours, billions of dollars in wealth simply vanished. Families lost everything. Banks collapsed. Businesses shuttered. And the world would never be quite the same again. But here's what almost nobody talks about. This wasn't some unpredictable lightning strike from a clear blue sky. This was inevitable. And the people in charge? They saw it coming. So why didn't they stop it? Better question, why did they actively make it worse? Today, we're diving into one of the most devastating financial disasters in American history, the crash that ended the Roaring '20s and plunged the world into the Great Depression. But this isn't just a history lesson. Because when you understand what really happened in 1929, when you see the patterns, the psychological traps, and the systemic failures that led to that catastrophe, you start recognizing those same patterns everywhere around us right now. And that should scare you. Let's rewind to the early 1920s. World War I had just ended, and America was riding high. Unlike Europe, which was devastated and broke, the United States emerged from the war as the world's leading creditor nation and industrial powerhouse. American factories were churning out cars, radios, refrigerators, everything the modern consumer could want. The economy was expanding at a dizzying pace. Unemployment was low, wages were rising, and a new era of prosperity seemed limitless. This was the age of jazz, speakeasies, flappers, and unbridled optimism. The American dream wasn't just alive, it was supercharged. Average people believed they could get rich, not through decades of hard work, but through smart investing. The stock market became the great democratizer, the place where anyone with a few dollars and some nerve could strike it rich overnight. But underneath this glittering surface, cracks were already forming. The foundation of this prosperity was far more fragile than anyone wanted to admit. And the financial system that was supposed to keep everything stable, it was actively encouraging the kind of reckless behavior that would bring the whole thing crashing down. Here's where it gets interesting. The Federal Reserve, created just over a decade earlier in 1913, was still figuring out its role. Benjamin Strong, the powerful governor of the Federal Reserve Bank of New York, believed that easy credit would fuel endless growth. So interest rates stayed low, money was cheap, and borrowing became not just acceptable, but encouraged. This was new, this was exciting, and this was extremely dangerous. Now let's talk about what happened when you combined easy money with mass psychology and zero guardrails. Throughout the mid-1920s, stock prices started climbing. Then they climbed faster. Then they went absolutely parabolic. Between 1924 and 1929, the Dow Jones Industrial Average nearly quadrupled. Think about that. In just 5 years, the stock market increased by almost 400%. And everyone wanted in. Shoeshine boys were giving stock tips. Teachers were day trading. Factory workers were convinced they'd retire millionaires. The market became a national obsession, covered breathlessly in newspapers, discussed at dinner tables, and treated as proof of American exceptionalism. The attitude was simple: stocks only go up. But here's the thing nobody wanted to acknowledge. Most of this wasn't real growth. It was speculation piled on top of speculation. And it was fueled by something absolutely catastrophic: buying on margin. Margin buying let you purchase stocks by putting down only 10% of the actual price and borrowing the rest from your broker. Imagine walking into a casino, betting $10, but somehow betting with $100 worth of chips. When you win, your gains are massive. But when you lose, you don't just lose your $10, you owe 90 more. This wasn't investing. This was gambling with borrowed money on a national scale. And the brokers, they loved it. Every margin loan meant more commissions, more fees, more profit. So they encouraged it. They made it easy. They told people it was smart. Banks started lending massive amounts to brokers to fund these margin accounts, creating a financial house of cards that grew taller and more unstable by the day. Meanwhile, the actual American economy was starting to show serious problems. Agricultural prices had been falling since the early 20s, crushing farmers who'd expanded production during the war. Consumer debt was skyrocketing as people bought cars and appliances on installment plans. The wealth gap was widening dramatically, with the richest 1% controlling nearly 40% of the nation's wealth. When you have that much inequality, you eventually run out of people who can afford to keep buying stuff. But Wall Street didn't care about any of that. The party was too good. And anyone who suggested maybe, just maybe, this couldn't last forever was dismissed as a pessimist, a fool, or someone who just didn't understand the new era of American capitalism. Summer of 1929. Behind the scenes, the smart money started getting nervous. Production was slowing, inventories were piling up, Europe's economy was struggling, and stock prices had become completely disconnected from actual company earnings. Some stocks were trading at 30, 40, even 50 times their earnings. That's not investment, that's pure mania. In September, a few cracks started showing. The market had a bad day, then another. Some investors started selling to lock in profits, but most people held on, convinced this was just a temporary dip before the next surge upward. They'd seen these little corrections before. They always bounced back. Then came October. On October 24th, Black Thursday, panic selling began. Nearly 13 million shares traded hands, an unheard-of volume. The ticker tape fell hours behind, meaning nobody actually knew what stocks were worth anymore. They were buying and selling blind. A group of prominent bankers met at JP Morgan's office and pooled their money to buy stocks and stabilize the market. It worked, briefly. People breathed a sigh of relief. But that relief was short-lived. On October 28th, Black Monday, the market plummeted 13%. And then came October 29th, Black Tuesday, the worst day in stock market history up to that point. Over 16 million shares traded. The losses were catastrophic. The ticker didn't catch up until after 7 p.m., hours after the market closed, and when it did, the numbers were devastating. Here's what made it so brutal: the margin calls. When stock prices fell, brokers demanded that margin buyers either put up more cash or sell their stocks immediately. But there was no more cash, so they had to sell. And when millions of people have to sell at the same time, prices crater, which triggered more margin calls, which forced more selling. A death spiral that fed on itself, destroying wealth at an unprecedented rate. In the weeks and months that followed, the full scale of the disaster became clear. By mid-November 1929, the market had lost nearly half its value. But that was just the beginning. Over the next 3 years, stocks would continue falling until they'd lost almost 90% of their peak value. 90%. Banks started failing by the hundreds, then by the thousands. See, banks had invested heavily in the stock market, and they'd also made countless loans secured by stock that was now worthless. When people rushed to withdraw their savings, banks didn't have the cash. They'd lent it out or lost it. Over 9,000 banks would fail during the Depression, wiping out the life savings of millions of Americans who'd done nothing wrong except trust the system. Unemployment exploded from 3% to 25%. That's 1 in 4 Americans out of work. Factories closed, farms foreclosed. Bread lines stretched around city blocks. Shantytowns called Hoovervilles sprang up as people lost their homes. And this wasn't just an American crisis. The U.S. economy was so interconnected with the world by 1929 that when we collapsed, we dragged everyone else down with us. Now here's where it gets really frustrating. The government's response made everything worse. President Hoover and his advisors believed the market would correct itself if left alone. They insisted on balancing the budget, which meant cutting spending exactly when people needed help most. They raised interest rates and taxes, sucking more money out of an already struggling economy. The Federal Reserve, which could have flooded the system with cash, instead let the money supply contract by a third. Every policy choice seemed designed to make the Depression deeper and longer. It wasn't until Franklin D. Roosevelt took office in 1933 and launched the New Deal that the government finally took aggressive action. But by then, the damage was incalculable. An entire generation was traumatized. Trust in institutions was shattered. And the world had learned, or so we thought, that unregulated speculation and blind faith in markets always ends in disaster. So why does this matter now? Because we keep making the same mistakes. We just call them different names. Think about 2008. Subprime mortgages, derivatives, collateralized debt obligations. Different instruments, same psychology. People borrowing money they couldn't afford to buy assets whose prices only went up until suddenly they didn't. Financial institutions taking massive risks because the profits were enormous and they assumed someone else would bail them out if things went wrong. They were right, by the way. We did bail them out. Or look at what happened in 2021 and 2022. Meme stocks, cryptomania, NFTs, SPACs, 0% interest rates fueling speculation in everything from tech stocks to real estate. People quitting their jobs to day trade. Everyone convinced they'd discovered some new paradigm where old rules didn't apply. And then interest rates went up, and trillions in paper wealth evaporated. The pattern is always the same. Easy money creates bubbles. Bubbles attract speculators. Speculation becomes mania. Mania becomes euphoria. And euphoria becomes panic. The only thing that changes is how long the cycle takes and what we're speculating on. Here's some data that should terrify you. As of late 2024, margin debt in the U.S. stock market was back near record highs. Household debt has hit all-time records. The wealth gap is wider than it was in 1929. And despite everything we supposedly learned, despite all the regulations we put in place after previous crashes, we've systematically dismantled many of those safeguards because they were inconvenient and they slowed down profit-making. We're also seeing the same cultural signs. The explosion of retail trading apps that gamify investing. Social media influencers promising to teach you how to get rich quick. A pervasive belief that traditional investing is for suckers and the real money is made through aggressive trading or finding the next big thing before everyone else. This is 1929 thinking with smartphones. So what are we supposed to take away from all this? 3 things. First, bubbles are psychological before they're financial. They're fueled by greed, yes, but also by genuine belief, by social pressure, by the fear of missing out, and by the very human tendency to assume that this time is different. It never is. Understanding the psychology makes you less susceptible to it, but it doesn't make you immune. Nobody is. Second, easy money always creates problems down the line. When credit is cheap and abundant, it flows into speculation rather than productive investment. Low interest rates might stimulate the economy in the short term, but they also encourage the kind of leverage and risk-taking that leads to devastating crashes. There's no free lunch. The bill always comes due. Third, institutions don't automatically save us. The Federal Reserve, the banking system, the government, they're run by people with their own biases, blind spots, and incentives. Sometimes they make things worse, even when they're trying to help. Regulation matters, but only if we actually enforce it and don't dismantle it the moment it becomes inconvenient for powerful interests. Here's my warning. We are living through an era of unprecedented monetary experimentation, wealth concentration, and financial speculation. The tools are more sophisticated, the markets are more complex, and the global interconnections are deeper than they were in 1929. Which means when the next crash comes, and it will come, it could make 1929 look manageable. So here's my question for you. What are you going to do about it? Because saying someone should do something isn't enough. Are you going to educate yourself about how these systems actually work? Are you going to push for real financial regulation and accountability? Are you going to look critically at your own financial decisions and recognize when you're being swept up in mania? Or are you just going to assume it'll work out somehow, the same assumption people made in 1929? History doesn't repeat, but it sure as hell rhymes. And right now, we're hearing some very familiar verses. If you found this video valuable, hit that subscribe button, because we're going to keep exploring these patterns, these systems, and the forces shaping our economic reality. Knowledge is the only real protection we have. Let's use it. Thanks for watching. See you in the next one.